Welcome to this Killick Explains video, and welcome to a rare bright spot in what seems like a lot of gloom at the moment pervading both the global economy and to a degree markets. And that bright spot is basically 5 bullish signals for equity investors. So I'm going to look at 5 ways you could put a positive spin potentially on the stock market right now, even if there is plenty of commentary out there which is doing the exact opposite. So first of all, a few health warnings. And the first one's got to be something I always say, which is market timing per se is a bad idea. That's not really what this video is all about. No one rings a bell at the bottom of the market, and they're not going to do so this time, whether they're the Federal Reserve, the Bank of England, or anybody else. And opinion is divided on what follows. So all of the 5 points I'm about to make can be countered, all right, and perhaps in a future video I'll explain exactly how and why. But if you were making the bullish case, then these would be 5 of the stronger arguments that you could use. So the first one is a low forward price earnings ratio. Now, investors tend to look ahead rather than backwards. So whilst there is a thing called the historic price earnings ratio, I prefer to use the forward one. All right, it is a little bit more subjective, but it is the one where people are trying to look through current gloom to the future. So it's a measure of cheapness, the first thing to say about it. So how cheap or expensive is a share? I've covered this in other videos. It compares the current price to forward earnings. So for example, if the current share price is 200p, £2, forward earnings, a consensus of forward earnings derived from analysts in the market, let's say, at 20p, then the forward PE ratio is simply 10, 200 over 20. All right, and then you'd have to ask yourself, well, what does that tell me? That 10. I'd need to look back and see what it's done in the past. I'd need to look around. So I'd need to be looking at a specific stock or group of stocks and benchmarking, if you like, and I'd have to think about my own expectations. But the bottom line is, if you just take the simplest way of looking at it, forward PEs in some parts of the equity market are now at multi-year lows. Now that's not to say we should all be trying to catch a falling knife. It's not to say stocks can't fall further, but it is an eye-opener when you hit a point where stocks are trading at lows on forward PE multiple bases we haven't seen for a long time. So there's one to think about. But one piece of evidence is rarely enough to make an investment case. So number 2 would be dreadful sentiment. Now you can read sentiment in all sorts of ways. You can look at magazine covers, for example. There are people who follow what The Economist do and ask the question, have we at the top or the bottom of the market as a result? You can look at fund managers, but there is a thing called the AAII, which is a survey of investors. It's quite influential, and at the moment it's extremely negative. There are very few bulls out there. And without going into the detail of the mechanics of that survey, some people would say when that survey throws up highly negative sentiment, you might be seeing a point where people have sort of thrown in the towel, and if you're brave enough, it could be a time to buy. Then there's high volatility. Now volatility is not something that investors can avoid. It's not something to be scared of as such. It is, as Warren Buffett put it, the price we pay for long-term growth. Returns from the stock market are not free, if you like. And on some indicators, the VIX, for example, which is a famous options-based measure of volatility, volatility has spiked sharply. All right, over the summer that can be exacerbated by low levels of liquidity in stocks, low turnover, if you like, but nonetheless, volatility is pretty sharply up. And some people would say high volatility will tend to scare other investors away, and that's precisely when the braver investors, the ones who are prepared to be greedy when others are fearful, make their move. All right? And it's worth bearing in mind that as a private investor, you do have a little advantage here insofar as you're not reporting other than to yourself every quarter. Some of the bigger institutional investors have to take account of volatility for fear of missing their targets being down the bottom end of their peer group and so on. So there's number 3. Number 4, investors, you must have noticed, are behaving very defensively. A lot of people are holding on to quite a lot of cash and wondering as a result what to do with it, where to earn a decent return. The higher risk end of the market, some would say, the tech end of the market has been battered. All right, that can be a sign that investors are wrongly or rightly behaving short-term defensively. And equities in general have seen, a move away, if you like. On the whole, on average, without generalizing too much, allocations to equities, whether institutional or private, have been reduced recently. Now, they could go further, but nonetheless, defensive behavior, evidence on the part of investors, can be a sign that the market is reaching something like a bottom. And then inflation might be peaking. Now, this is a slightly different argument. A lot of the pessimism baked into the market is built around inflation at 40 plus year highs, heading up to and above double digits across many major economies. All right, but the fact is, because of the uncertain environment, corporate and consumer spending is slowing. Private sector wages are now only creeping up, actually, and certainly not keeping pace with inflation in the majority of cases, and central banks have started to disagree. There is tension out there about the pace of interest rate rises to deal with inflation, and also where they need to go, those interest rates, to control it. And when you see friction between central banks, areas of disagreement, that can indicate that we're starting to head towards something of a peak. Things, as the famous lyric goes, can then only get better. So, important to take a balanced view. Am I giving you a recipe for spotting the bottom of the market? Absolutely not. No one has that recipe. All 5 of the points that I've made here can be countered, and hindsight bias, rear view mirror investing is always a danger. May look back in a year's time and go, ha-ha, I was right, but we won't know that for another year, okay? So I'll leave you with this thought, all right? And this is really the key to it. If, as a long-term investor, you're looking at a holding that you like the look of, something you want to get into, and a year ago it was 20% more expensive than it is now, why would now be a bad time to get into that same position? I mean, yes, maybe it'll end up 25, 30% cheaper than it was a year ago, but I leave that thought with you, that if your original analysis of what makes a long-term investment was correct, the entry point is less important in one sense, but now might be a good opportunity to buy something you like a little bit cheaper than the price you would have paid not so long ago for it. Okay, lots of jargon there, PE ratios, for example, sentiment indicators. So tap into my extensive video library to find out more about those. That's killick.com/learn and the shares tab down this side. If you'd like to read about equity investment and a bit more on PEs and all that sort of good stuff, they're one of my guides. It's not one of these two, but How to Invest in Equities is editor at killick.com. And if you'd like to see some of this stuff sort of live, as it were, wrapped around some actual investment ideas, which is where my brief stops, but you can start here. Confidant, editor at killick.com, our quarterly magazine, usually has a section on equities.